Hi, everybody. It's Ann Moratto with Modern Salon, Content Director, and I am so happy to be talking today with April McDaniel from the firm Kopsa Otte. April is a certified public accountant and advisor, and we were talking a couple weeks ago about content that would be really valuable for independent beauty professionals. And I've heard April speak before, and she talks about, things that might sometimes go over my head in a way that is very relatable. And she's going to demystify and make not so scary a few things about taxes. So we're going to talk about taxes, specifically some red flags that we might set up that the IRS pays attention to. So April, long introduction to you. Thank you so much for coming and for being with me right now.
Thanks, Anne. I'm excited to be here. Taxes are fun, right? So why not spend a little bit of time talking about what the IRS wants and doesn't want, and maybe a little bit about the Department of Labor too and your state regulations. So I'm excited. I'm ready to get going. What questions do you have for me?
Good. Taxes are fun. And I said I never. The first one is, when a stylist or beauty professional moves from a commission-based salon to opening their own salon suite or studio, will their taxes automatically become more complicated?
The answer to that is yes. If you're at a commission-based salon as an employee, you get what's called a W-2. And the W-2 records your earnings. That comes from your boss, from your employer, and then another copy of that goes to the IRS. So, when you go to do your tax return, it's a simple 1040. Those W-2 wages go right on the front page, and you're not having to keep track of other things really as it pertains to your work as a stylist. But when you become a suite renter or an independent contractor, all of a sudden you are a business person. And I'm really glad you're asking this question, because I think this is something that sometimes people forget about when they make that jump from being a commissioned employee to being an independent stylist or booth renter. Obviously not just stylists, but massage therapists, estheticians, nail techs, you name it. What happens then is typically we see these independents recording their business on what's called a Schedule C. So for those of you out there that are in this position, I would say Google Schedule C on the IRS website, and it'll give you an idea of the types of things that you need to be keeping track of, because you're not only going to have to tell the IRS what you brought in for your service sales and your retail sales and your tip income, you're also going to want to deduct expenses that you have to provide those services and sell that retail. So, things like your back bar costs, your professional products, what did it cost you to buy that retail product before you sold it? Merchant fees and things like that really kind of vary with the sales that you have. And then on top of that, you're going to have fixed expenses like advertising and rent, and maybe some legal and professional fees to make sure you have good liability insurance and a good lease set up with whoever you're renting from. You're going to have, possibly some utilities that you pay, and maybe some expenses like foils or things like that would be general supplies. So again, I'd say Google Schedule C, take a look at that, and make sure you have somebody that can help you set up some systems in order to keep track of those things throughout the year. You're going to get the best deductions if you don't wait until after January of the following year to keep track of these things. So make sure you're keeping track of them all year long so that you have a good opportunity to get those deductions.
That's great. And I'm going to ask you a little bit more about deductions.
Okay.
So I did ask, are there business expenses that you cannot write off on your taxes, but many think that they can? I think there's a lot of sort of urban myths about what you can write off versus what you can't. And I want you to tell us some things that we might think, oh yeah, I can write that off, but no, you can't.
Well, probably the biggest one that comes to mind is trips and automobiles. Now, when it comes to a trip, obviously, if you go to a conference, your conference fee that you pay related to your business or your trade would be something you could expense or deduct. Maybe your mileage to get there, or your airfare to get there, your hotel, certainly your meals. Now the IRS kind of keeps going back and forth on whether a travel meal is 50% deductible or 100% deductible, but you'd want to track those things. But oftentimes what we see is that, I'll give you a great example. Sometimes I speak at ISSE in Orlando. And what else is in Orlando? Disney, right? And so people come and they go to ISSE, or maybe they go to Long Beach for the conference, and they decide they're going to spend an extra couple days and they're going to vacation. And that's where we see problems. The IRS doesn't mind if you deduct things travel related to business, but deciding to take your whole family or going on trips for entertainment purposes, those aren't deductible. And so those are things that we see that people try to deduct that they really can't. Now, I want to say, Anne, that all of the things that I'm talking about today, you should really talk to your professional, because, this is a very short interview. And there might be things that allow for pieces of that to be deductible. And so I don't want you to say, well, April said I can't deduct that, when maybe if you do things right, some of it is deductible. Okay. So make sure you're asking your accountant about that. The other thing with autos that we see is there's this myth that if I put a wrap on my car that advertises my business, all of a sudden I can deduct the whole car. And that's not true. Now, you could deduct the price of the wrap. And if you're using that car for business purposes, typically what we see is that it makes the most sense to track your mileage and get paid back mileage on that car. So the business use of a vehicle really has to be the primary use of the vehicle for it to be deductible. And you don't get to deduct your commute back and forth to work. So that's where that myth really happens, is that, if you are driving from home to your booth, or you're driving from home to the salon, or whatever you call the place that you work, that commute is not deductible. And so that's one of the biggest things that we see.
I thank you. I like you being able to call out those specifics. And yes, this is not to be taken as, the end all be all of advice. This is April sharing some editorial information with us, but always, confirm this with your team of professionals. So
Sure.
you told us what you cannot write off. Are there expenses you can write off, but it's not commonly known that you can? And again, these are things, that people would have to confirm.
Yeah. So I think a lot of times people miss things like damaged clothing. So we know in your line of work that oftentimes your clothing gets damaged, right? You get color on your shirt, or that awesome pair of pants you bought. Maybe you get oils because you're a massage therapist, and all of a sudden you can't wear that awesome shirt you bought out anymore. And so what you should be doing is, when that happens, keep track of the value of that clothing item and deduct that. So if you're not sure what it's worth, think about what it would be worth if you gave it to Goodwill. So, this shirt here, for example, I think when I bought it, I probably paid $65 for it, but I've worn it a lot. So if I was going to donate this to Goodwill right now, maybe I would put $25 on it, maybe. But if I ruined it, I can't put 65 on it just because I want to take a bigger deduction. It's 25. Okay. And then the real kicker is, don't be wearing it when the IRS shows up to audit you. Okay. Because if it's truly destroyed, you can't wear it anymore. So get rid of it. Okay. And I think the other thing to think about is that I know in this profession, it's really, really important for you to look good, right? This is a profession where what you look like really advertises for your business, but that doesn't mean that you get to go out and buy a $250 pair of shoes and deduct them. Now, if you bought those shoes and then you somehow ruined them providing a service, you might be able to, but again, don't be wearing them when the IRS agent shows up to find out if you really did ruin those $250 pair of pumps. So those types of things. The other thing that we see sometimes that people miss is really taking a look at what type of entity that you are. Now, when we first started this conversation, I said, take a look at, a Schedule C. And that's usually what people start out as. They're a sole proprietor, and it's a very simple, when you think about tax theory or tax processes, it's a fairly simple schedule, but there are other forms of business that you might operate in. And things like S corporations and C corporations, and we don't see many C corporations, maybe a partnership. But when I say we don't see very many C corporations, I mean in the salon world. We do see them in other businesses, but make sure you're talking to your CPA about your form of entity, because it's not a one size fits all. You might start one way, and a few years later, when you get to be really successful, you might want to change that. And you change that because of things like reducing self-employment tax, or possibly being able to give yourself a W-2 paycheck, things like that. So we see that missed a lot too. The other thing that we see that's missed a lot is just people being diligent about keeping track of expenses. In order to really deduct all of the things that relate to your business, you need to be keeping documentation. So, it's kind of like, if I think about where I was 6 months ago, I probably couldn't tell you who I ate dinner with that night and did I talk about business. But if I keep a little journal and I write down, we went to Outback Steakhouse and we spent $50, and it was me and Ann, and we talked about upcoming data driven or something like that, right? Then I'm going to have that information so that when I go to see my CPA, I can say, see, I talked about business. This is deductible. Okay. So things like that.
That's so helpful. I'm going to give you one more question, and then I'm going to ask you where people can go to just sort of continue to build their business acumen.
Sure.
What are some things that will throw up a red flag on your tax return? What is something, maybe just one or two things that might prompt an audit?
Well, I think you have to remember that in this business, cash is very intensive. And the IRS knows that. And when I say cash, I mean not just physical dollars. I mean things like PayPal and things like Venmo and things like Tippy and things like that, where you're getting dollars, maybe indirectly from outside of maybe your service or retail software that you use. The IRS knows that you're getting those things. And so they are looking in your tax return for the reporting of that tip income, okay? And they get reports, what they call matching documents, from companies. This year will be the first year that Venmo will have to give them if you have over $600 worth of income, business income. And so they're matching documents, whether it's a W-2, they're matching to your tax return, which of course is if you're an employee, but they're also matching things like a 1099K, which is what a merchant service provider has to give the IRS. So like if you're processing Visa or MasterCard through Square or whatever you're using, they get a report and they match that up. And if the amount of sales or the amount of income on your return isn't greater than what you've processed on credit cards, they know you're hiding cash because they know you've gotten some cash. Okay, so that's a big thing. And that I think applies not just to providing services and income for that. I think it also applies to tip income. Tip income is a really big thing that we see that people try not to report. So,
April, thank you so much for giving us so much to think about, so much to be aware of. So as I mentioned, how can somebody, if they want to stay a little bit close to Kopsa Otte, close to April, how can they sort of hear a little bit more from you and what you do and get a few more business, tax, financial tips?
Sure. So I think the best thing really is to get on our website, and that's www.kopsaotte.com. I'm going to spell that. So guys, get your pencils ready or your pens ready. It's KOPSAOTTE.com. And then right at the top, there's a place where you can sign up for our newsletter. And we do industry specific newsletters. We have a salon one. We actually do business with distributors as well, and also ag, because we're in Nebraska. But we send out newsletters every couple weeks, and they're tailored to the salon and spa industry, because we do this in 43 states. We have clients across the country. So that would be the best way for you to try to stay up to date with what's going on and changes with tax law, and topics that we see that are relevant, no matter what time of the year it is.
Thank you so much, April. Thanks for making it so easy to understand. I thought this was going to be a little stressful, but this was actually, this was very easy and very pleasant, but you made it so. So thanks so much, April.
Of course. Thank you. Thank you.